In this video, let's discuss what is a depreciation expense. So depreciation expense is the cost of using an asset over its useful life. Example, you started a coffee shop business. To start a coffee shop, you have to purchase certain assets like a coffee maker, tables and chairs. You can also have costs in renovating and so on. When we purchase this coffee maker, table improvements, we capitalize them as asset. As we run our business, the cost in using these assets will be recorded as depreciation expense. For example, a coffee maker. You bought this coffee maker for 450,000. You project that this coffee maker will last for 5 years. Depreciation is computed on a monthly basis. So the estimated life, you convert it into months. So the 5 times 12, so that's 60 months. So to compute depreciation, just simply divide the 450,000 over 60. The result is 7,500. That means every month, you're incurring a depreciation expense of 7,500 for the use of that coffee maker. Do the same for the other assets like the tables and chairs and the leasehold improvements. And once you compute all the depreciation of these assets, you will have a picture of how much you're spending every month or how much you're spending in using these assets in running your coffee shop. Why it's important to monitor depreciation? First is because depreciation is usually as an unseen expense in doing business. If you record and compute depreciation, you have a clearer picture of how much you really spend every month in running the business. And then second reason is for your costing and pricing. Because if you don't compute depreciation, you might think that you don't have much cost in producing the coffee that you're making. If you incorporate your depreciation of fixed asset in your pricing, or if you incorporate depreciation, you can better price your products. Lastly, third is for tax purposes, depreciation are allowable expenses. So that means if you record it as an expense, your income will go lower and eventually your income tax will also be lower.